Let's get across the market open. Kyle Rodder joining us from Capital.com. Kyle, welcome to Thursday. Risk assets coming off overnight. Certainly some consideration about the path of future interest rates.
Yeah, and if you look at the margins, a cut for October and December, the odds have diminished very slightly, down to about 90% for the October decision and about 75% for the December decision. So really it's a bit of a momentum trade there. We've seen some kind of cautious Fed speak over the last couple of days, arguably some of the hawks coming out as well, just talking about the upside risks to inflation. Austin Goolsbee has sort of become the head of the flock, so to speak, for that one. But really, we've just had a bit of a blowing off of some of the froth on the top of equities in the last few days, really as the momentum behind that rate cut narrative comes out of the market, again, really by virtue of some of this Fed speak that's just added a little bit of colour to the rate outlook over the next few months. So not much remarkable. Volatility is quite suppressed. It was really a night where we've just seen some of those big prevailing trades unwound, which is to say stocks off a little bit from their highs. The dollar has recovered a little bit. Gold's down a fraction too. Yields kind of changing shape after last week's kind of pop as well. So really not much to sort of write home about. Certainly the markets are still very, very bullish. But again, just a lack of momentum in a fairly slow news week has meant that, really we've just seen this little dip that should manifest in a slightly sluggish open in Asia as well this morning.
What markets, or who are they listening to? Obviously, we did hear from Jerome Powell earlier this week, but there is something of a battle going on within the FOMC at the moment, isn't there, just in terms of the commentary that we're hearing?
Yeah, I think how I would describe it is sort of like a tale of two Feds. There's the Powell Fed that is going to be relevant for the rest of the year and arguably the start of next year, but there'll be really a diminish in terms of how how much the markets follow Powell's commentary going forward will diminish going into next year because his guidance will be worth less. And then there's the other Fed, which is, speculating what the complexion of the board will look like after May next year when Powell leaves, and presumably we'll get a very, very dovish chairperson who might mirror the voting patterns and worldview of someone like Steve Maren. So the markets are kind of working out, okay, what weight do we put on the commentary that we're getting this week, given that some of it's going to be very relevant for the near term, but not so relevant in the long term. And, obviously, as we've seen over the last few days, Powell's commentary about sort of a cautious approach going forward and, the pass-through of tariffs to prices manifesting in the data over the next few months, balanced against a kind of uncertain outlook for the labour market, has kind of led to this slight drop in the implied probabilities for rate cuts in the next couple of meetings. But then again, there's this kind of dynamic of, okay, what is things going to look like from May next year and onwards? And that's where I think markets, equities in particular, have taken a lot of confidence from, is that we're going to get basically, if not rate cuts that take the federal funds rate basically back to neutral very quickly, almost into stimulatory territory. It brings with it inflation risks, but also that sort of pump primes the economy. So again, a sort of a tale of two Feds where the market is trying to weight the different perspectives based on, to what extent they're relevant over the short term versus sort of the medium to long term.
Kyle, I also note there is a lot of commentary just as to how far these equity markets have run. In fact, even the Fed Chair Jerome Powell referred to those highly valued asset prices. So clearly that's a big consideration for investors right now.
Yeah, without a doubt. And I think if you listen to most commentators, they're more or less saying that things are very, very expensive at the moment. There are these persistent fears about, bubbles, not just in asset prices, but, the kind of, fundamental dynamics of overinvestment in AI infrastructure and AI technology that could at some point in time prove to be a level of overinvestment, and that comes with its own costs if that were to materialize. So there's a real skepticism about why markets are at these levels. And I was actually saying it to a colleague this morning that the kind of phrase, price to perfection gets thrown around probably a bit willy-nilly. But if you do look at things at the moment, the markets are pricing in, obviously, continued growth for AI companies with multiples at very, very significant levels. 10% earnings growth or double-digit earnings growth going forward for the S&P 500. But we've also got rate cuts being priced in that is obviously supporting markets, but at the same time, a slowdown in the economy that won't manifest in a re-rating of earnings, and therefore a sort of a snapback in stock prices because of recession fears. We've also got those same markets sort of pricing in that inflation will pick up a little bit, but it'll be fairly transitory, and we can look through that. There's not a huge risk of a runaway inflation dynamic as well. All of those things rely on a very particular set of circumstances or particular economic environment prevailing next year, which I think can be appropriately said that markets are pricing things for perfection. Turning points are really hard to call in the markets, but what you can say, as I've said in the past, when a market or an equity market in particular might be prone to shocks, and that's when valuations are around these levels and sentiment is bullish, if not slightly complacent. So things could continue to run. It's probably a buy the break market where if we do get good news, you sort of buy the break out to the upside. But in saying that, we're only really one reasonable negative shock away from a bit of a correction, and it could come in any form.
Now, you mentioned those rate cuts been priced in stateside. Something of the opposite going on here. You would think rate cuts been priced out, particularly off the back of that latest inflation read.
Yeah, we're down to one cut being fully priced in, and that's been deferred to the first meeting of next year, which may have changed in the last 18 hours since I've checked. But we're looking at, say, a 70% implied probability of a December cut, which not so long ago was fully baked in. I think the reaction to the inflation data seemed a little bit in excess of what was appropriate, really on the basis that we saw the trim mean number moderate back to about 2.6%. It is obviously a partial read, and that the headline number jumped to the top end of the RBA's target band, really by virtue of this continued roll-off of some energy subsidies in a few states across the country. So the fact that the markets reacted so aggressively, especially the equity market reacted so aggressively to these figures yesterday, is I think a little bit in excess of what the reality is when it comes to inflation going forward. But in saying that, it does raise some doubts about the RBA's ability to cut rates aggressively to protect the labour market. Of course, we will get, fortunately, in November, the CPI index moving to a monthly read, so the indicator will turn to the full read on CPI, and that's when we'll start to get a better colour of what's actually happening with inflation. And the RBA as well will probably start directing their commentary to those official prints on a monthly basis rather than the quarterly ones. They have had the tendency to ignore the indicator, obviously, because it's a little bit more noisy. It doesn't encompass the full CPI basket. But nevertheless, again, it's raised doubts about the RBA's ability to cut interest rates. That's led to fewer rate cuts being discounted into the market, with some doubts about a cut this year. And naturally, an equity market which is really only rising by virtue of rate cuts more globally, as well as probably some passive flows just going into equities, as that kind of proverbial rising tide lifts all boats. The lower odds of a rate cut in a fairly weak fundamental market, fundamentally without strong earnings growth, is going to result in a bit of a knee-jerk reaction, and that's what we got yesterday. But once more, cuts are still on the table. The timing is now just being pushed out a little bit.